A sudden, vicious market reversal usually catches retail traders completely off guard. In an instant, a portfolio built over months can be dismantled by a single, sharp directional change. Most independent traders fall victim to these drops because they rely entirely on standard price charts. These charts are highly subjective and frequently manipulated by professional trading desks to hunt retail stop losses. The true driver of these reversals is smart money. These are the major banks, hedge funds, and large financial institutions that possess the massive capital required to force market direction. This institutional capital acts as an invisible force, gliding silently just beneath the choppy surface of the market, moving prices unseen by the average observer. While these institutions can easily mask their true intentions within the noise of standard price action, there is one metric they cannot manipulate: the sheer size of their trades. By tracking this physical footprint, an analyst can begin to see the mechanical intent that price action alone attempts to hide. This is a historical stock exchange floor. To read the market here, analysts developed volume spread analysis, or VSA, the objective study of price behavior, strictly in relation to its corresponding trading volume. Before digital screens, manually tracking this data directly from the ticker tape was the only accurate method to decode the true underlying sentiment of the professional floor traders. VSA relies on volume because it represents a strictly non-subjective frequency of transactions. It is a hard mathematical reality that cannot be faked. A prominent industry critique claims that VSA is useless in decentralized markets like Forex, arguing that without a centralized exchange, there is no real volume data to measure. This is an incomplete understanding of market data. In Forex, traders use tick volume as a highly accurate mathematical proxy for actual transaction volume. Statistically, tick volume correlates directly with real volume over 90% of the time, making it a perfectly viable metric for structural analysis. Regardless of the specific asset class, volume provides an objective metric to verify the underlying imbalance between supply and demand. This isolates the core components of VSA. First is the spread, the physical difference between the opening and closing price. Next is volume, the transaction frequency during that specific spread. To classify this, we apply a 20-period moving average, establishing a mathematical baseline. Volume that peaks far above this line is classified as above average or ultra-high. These extremes represent confirmed smart money activity. As this volume is injected into the market, it drives a continuous four-stage Wyckoff cycle: accumulation, markup, distribution, and markdown. Understanding the microdata of a single volume bar is what allows a trader to pinpoint massive macro transitions within this overarching cycle. The foundational logic engine of VSA is simple. Volume is the effort expended by the market, and the price spread is the result achieved. This matrix outlines what happens when effort and result disagree. When massive effort yields no price result, it exposes friction. Look at the right side, a selling climax. It's a high-spread, bearish candle closing far off its lows, paired with an ultra-high volume spike. The logic is in the rejection. That downward wick proves institutional buying absorbed the selling pressure. Now look at the left side, the upthrust. A bullish advance stalls into a microscopic body, yet registers ultra-high volume. The effort is huge, but the upward result is zero. This indicates massive supply is overwhelming demand, acting as a concrete wall stopping the advance. These specific climax anomalies prove that standard price action is deceptive. The true reversal catalyst is the hidden institutional volume absorbing the market's momentum. The next classification of VSA signals is the disagreement. This occurs when the effort and result completely contradict across consecutive periods. This diagram shows a classic disagreement. We have a second candlestick with a much larger downward spread than the previous candle, but it forms on significantly lower volume. If price drops drastically without institutional selling effort, available supply is rapidly exhausting. Now consider the reverse. A small price spread occurs, but sits on significantly higher volume than the preceding candle. High effort failing to yield an upward price result proves that invisible institutional supply is secretly capping the market. Spotting these sequential disagreements allows an analyst to anticipate a momentum failure before it physically alters the chart's trajectory. The final class of VSA anomalies focuses on volumetric voids, specifically the no supply and no demand bars. This sequence illustrates a no-supply bar. It is defined as a low-spread, downward-wicking candle, accompanied by volume that is strictly lower than the two preceding candles. This specific signature indicates an absolute vacuum of selling pressure. With no supply left to fight through, buyers will face zero resistance pushing the price higher. There is a strict mandatory rule for trading these voids. They are purely continuation signals. They must never be traded as standalone trend reversals. A lack of supply is only actionable if it appears after a confirmed sign of strength. Used correctly, it serves as a green light to follow the established institutional trend. Ultimate VSA mastery requires zooming out from isolated candle anomalies to read the continuous narrative of order flow across the entire market cycle. On this macro chart, a confirmed selling climax maps to the bottom of the accumulation phase. Next, in the bullish markup, a no-supply bar confirms upward momentum. Finally, an upthrust at the peak triggers the markdown phase. This analytical process provides a framework based on raw volumetric mechanics, offering a data-driven alternative to the guesswork of subjective pattern matching. Applying the effort versus result matrix aligns a trader's execution with these institutional footprints, replacing retail intuition with a calculation of supply and demand.